We've all heard of value investing, a once sparsely known and thinly used investment methodology, invented by Ben Graham and then popularized by Warren Buffett and Charlie Munger. But what started out as a contrarian approach has over the last 100 years, due to the immense intellectual generosity of Ben Graham and then later Warren Buffett and Charlie Munger, over their more than 5 decades of market-beating performance at Berkshire Hathaway, has now actually become a mainstream method of investment valuation. Value investing is now so popular that more money is spent on hiring researchers and setting up and operating value investing funds than the cumulative value of the discounts to fair value on all of the stocks in the entire market. In other words, value investing has now reached a point where it is so saturated that more money is being lost pursuing value investing and trying to find those below value stocks than all of the value to be gained by finding them over the entire stock market. And I want to make it very clear that value investing as a broad term simply means trying to find investments which represent good value for money, in terms of getting more earning power and business value than the investor is paying for. And of course, no matter what asset class we are talking about or how saturated and competitive the market is, this principle is evergreen. But then again, that's not to say that value investing, in terms of actively pursuing below value stocks, is still a viable strategy for the average investor. Because as mentioned before, there is actually more money being spent on the whole in the pursuit of below value stocks than the cumulative value of all of the discounts available in the market. And this necessarily means that there is going to be more money lost than being made with this strategy. And of course this still means that there are those who are beating the market, but statistically speaking, unless the average retail investor has exceptional ability in this field, they are more likely to be worse off pursuing an active value investing strategy than being a passive investor and purchasing index funds and exchange-traded funds. But then again, investing into the popular index funds, like say the S&P 500, is now also so popular that the earnings yields are averaging around 2.5% per year, and the dividend yields around 1.5%, meaning that $1 million worth of the S&P 500 yields a dividend of around just $15,000, making financial freedom via this route, even with a dollar-cost averaging program and the help of long-term compounding, unfeasible to most average people. I mean, personally, I don't see the point of any investing strategy which is unlikely to ever create any meaningful degree of financial freedom for that particular investor, and for most people they will require at least $2 million worth of the S&P 500 to achieve that goal, assuming that they can live on and potentially support a family with $30,000 annually in dividends, which again, even considering long-term compounding, is out of reach for many people. And this idea of the investment markets being so competitive that most people are being priced out of ever being able to achieve any meaningful passive or supplementary income may be a tough idea to swallow, but actually it's a recurring part of every successful investing strategy. When Ben Graham originally started his career picking stocks in a post-depression era market, he had tremendous success buying shares of businesses he called cigar butts, businesses with poor financial prospects in terms of earning power and expansion, but also businesses which were selling so cheaply in a fear-stricken market that they could be liquidated for more than the cost of the shares, and a profit could be made either by buying enough shares to gain enough control to then compel a liquidation, or waiting until these companies came to a natural end. But by the later stages of Graham's career, the practice had gained so much popularity precisely because of its success that cigar butts became increasingly rare until they were effectively gone, rendering an entire investment discipline redundant. But of course, investors didn't simply give up. They adjusted and they found new investment strategies, for example the Berkshire Hathaway strategy of making large, highly concentrated investments into extremely good companies with strong franchises, when the market offered below-value opportunities from time to time. And of course, throughout the early stages of Warren Buffett and Charlie Munger's careers, many of these types of opportunities existed, and the market was far less efficient and the degree of asymmetric information between market participants was much higher, because there was no internet and investing was not a popular subject like it is today. But then gradually, as more and more investment managers and retail investors became familiar with and adopted value investing, they began to read books like The Intelligent Investor, and they began following the value investing model that most of us are now familiar with, in trying to find those mispriced investments and making big financial commitments in small numbers, as opposed to adopting an erratic and speculative high-volume approach. And I suppose that one of the unintended consequences of sharing the value investing approach so widely was that so many people began to adopt it that the benefits of value investing, which were primarily underpinned by the fact that it was a contrarian approach, which was superior to and more scientific than what most other investors at the time were doing, now meant that those advantages had been diminished to a significant degree with the increased competition. And so doing well with an active value investing approach, the type that Berkshire Hathaway built its portfolio on, is something which will not work for the majority of people today, simply because there are too many people trying to do it. Now, as mentioned earlier, this doesn't mean that the situation is hopeless. It just means that those investors who aren't satisfied with the comparatively low returns of the index funds will have to begin thinking outside of the box once again, and looking for new and less saturated investment strategies, where the opportunities are still plentiful enough to mean that success is achievable for the average investor. And this may mean specializing in a high-growth, disruptive industry, and trying to pick the big winners early on, or maybe moving out of the stock market and investing into small and medium-sized businesses on one of the many platforms which facilitate that kind of investment, or maybe even making our own investment. I've talked to people who have invested into allotments and small pieces of land, where they cultivate home plants to sell on, or even purchasing existing e-commerce stores or small businesses. The potential opportunities available to investors who are willing to put in the time into specializing and learning a particular industry or asset class, and finding less saturated investment vehicles and markets is vast. Anyway, that's all for this video. If you enjoyed it and you'd like to see more content like this in the future, be sure to subscribe to our channel and turn on bell notifications so you're always updated with new videos. Thanks for watching, and I'll see you all in the next video.